Priya opens her very first trade, EUR/USD, one standard lot, buy at the market. She hits confirm, and before the candle even ticks, before the market moves a single pip, her account is already down $12. No commission, the broker's homepage promised. She checks the platform for a glitch. There is no glitch. What just cost her $12 on a broker that charges zero commission is something every single Forex trade carries, whether you notice it or not. The gap between the price you buy at and the price you sell at. If you do not understand that gap, you will misread every trade you ever place, starting with your very first one. That gap is what this video is built around. Every currency pair quotes two prices at once. The bid is the price the broker will pay you to sell the base currency right now. The ask is the price the broker will sell it to you for, so you can buy right now. The ask always sits above the bid. The gap between them is the spread, and it is not a mistake, it is the broker's cut, built into the price itself instead of billed separately. The moment Priya bought at the ask, her position was instantly valued back at the bid, and that gap is exactly the $12 she saw disappear. So if there is no commission line on her statement, where did that cost actually go? Here is the part brokers do not put in the marketing. Zero commission does not mean zero cost, it means the cost moved. Every trade needs someone on the other side willing to fill it instantly, and the spread is the price of that immediacy, paid every time you enter and again when you exit. A broker advertising no commission has simply folded that fee into the distance between bid and ask instead of writing it as a separate charge. The cost is the same, sometimes larger. The only thing that changed is where you can see it. So before you trust a zero commission label, you need to know exactly how that hidden fee gets measured. Spreads are measured in pips, and the decimal point matters. On most pairs, including EUR/USD, price is quoted to 4 decimal places, and 1 pip is that 4th decimal. On any pair involving the Japanese yen, price is quoted to only 2 decimal places, so 1 pip sits at the 2nd decimal instead. A spread of 1.5 pips on EUR/USD and a spread of 1.5 pips on USD/JPY are the same size in pips, but you have to know which decimal you are counting. Here is your turn. Pause this video right now. Pull up your own broker's EUR/USD quote and count the difference between the bid and the ask in pips before I go further. Got a number? Good. Now the real question, does that number ever change? For some brokers, the answer is no. These are dealing desk or market maker brokers, and they quote a fixed spread that stays the same whether the market is calm or on fire during a news release. That fixed number is genuinely useful. It means you can open a small account and still know your exact transaction cost on every trade before you place it. No surprises. But fixed comes with a trade-off. Because the broker cannot widen that spread to protect themselves in fast markets, they sometimes cannot fill your order at the price you clicked. Instead, you get a requote, a new price offered after the fact, or your order slips to a worse price than you expected. Predictable cost, unpredictable fill. So what does the other model trade away instead? Non-dealing desk brokers run it the opposite way. They plug your order straight through to a pool of liquidity providers, banks and institutions competing for your business, and the spread you get floats with real supply, demand, and volatility in that moment. Because there is real competition behind every quote, pricing tends to be tighter and more transparent, and critically, there are no requotes. If liquidity gets thin, the spread just widens instead of your order getting rejected. That sounds like a clean win, until volatility actually spikes. During a major news release, a spread that normally sits at 1 pip can jump to 10 or more in seconds. For a scalper chasing a 5 pip target, that widening alone can erase the entire trade before price even moves. So which one actually fits a trader like Priya? Remember, context beats the pattern, the stop is what saves you, and nothing replaces practice on a live chart.